I'm Devon Coombs, CPA, MBA, lecturer at San Jose State, ex-Google and Deloitte, and a top consultant in the Bay Area. Today we're covering the 10 golden walnuts. Sorry, this isn't a Stardew Valley stream. Today we're covering the 10 golden rules of finance and valuation. These rules will help you prepare for any exams you may have and, more importantly, understand how money and markets really work. Let's jump in. Rule 1, the seesaw of value. Bond prices and interest rates move in opposite directions, like a seesaw. When interest rates rise, existing bond prices fall. When rates fall, bond prices rise. Why? Because a bond's coupon is fixed at issuance, but the market yield moves with interest rates. If your bond's coupon is higher than current yields, it's attractive, so it trades at a premium. If the coupon is lower, it's less appealing, so it trades at a discount. When you face a bond valuation question, ask yourself, does this coupon pay more than the market requires? If yes, you'll pay a premium. If not, you'll only buy it at a discount. Rule 2, time and risk. The longer you wait for cash flows, the riskier the asset. When considering bonds, this sensitivity to interest rate changes is called duration risk. Zero coupon bonds have the highest duration because all their cash comes at maturity. Even small shifts in interest rates create large percentage swings in their price. Coupon bonds spread payments out over time, which cushions the impact. Callable bonds add another twist. They have a price ceiling because if rates fall, the issuer can call or buy back the bond early. That limits your upside. For callable bonds, always evaluate them using the yield to worst, which reflects the lowest return you could earn if the bond is called before maturity. Rule 3, cash flow is king. A company's value ultimately comes from the cash it generates, not just its accounting profits. That's why investors focus on free cash flow. Free cash flow to the firm, FCFF, is the cash available to all investors, both debt and equity, before any interest or principal payments. Think of it as the total pie the business creates. Free cash flow to equity, FCFE, is what's left for shareholders after debt holders have been paid. This is the slice of the pie reserved for equity investors. Here's the twist. If a company borrows more money than it repays in a given period, FCFE can actually be larger than FCFF. That's because the extra debt adds cash that flows directly to equity holders once obligations are met. So when valuing a company, remember, FCFF reflects the business as a whole, while FCFE zooms in on what equity investors personally take home. Rule 4, growth costs money. To grow, companies must reinvest. That reinvestment usually takes two forms: capital expenditures and working capital. Capital expenditures, or CapEx, are big-ticket items like new machines, buildings, or technology. These investments reduce free cash flow today, but they're made in hopes of boosting productivity and profits tomorrow. Working capital is the money tied up in short-term operations, things like inventory, accounts receivable, and accounts payable. If a company builds up more inventory, cash goes out the door. If customers take longer to pay their bills, accounts receivable increase and cash flow decreases. On the flip side, if a company delays paying suppliers, accounts payable increase and cash flow improves. Aggressive growth often means higher CapEx and more working capital tied up in operations. That lowers today's free cash flow, but sets the stage for higher cash flow in the future. So the trade-off is clear. Reinvest now, sacrifice some cash today to hopefully generate more cash tomorrow. Rule 5, risk requires reward. In finance, more risk means investors demand more return. The capital asset pricing model, or CAPM, gives us the framework. The central measure is beta, which compares how volatile a stock is relative to the market. A beta of 1.0 means the stock moves in line with the market. If the market goes up 10%, the stock goes up about 10%. A beta of 1.5 means the stock moves 50% more than the market. If the market rises 10%, the stock may rise 15%, but if the market drops 10%, the stock may fall 15%. A beta below 1.0 means the stock is less volatile than the market. Now here's the bridge. CAPM says the required return on equity equals the risk-free rate plus beta times the market risk premium. So if beta is higher, the required return is higher. Here's an example for you. Company A has a beta of 1, Company B has a beta of 1.5. Both companies have a risk-free rate of 3% and a market risk rate of 6%. That difference in required return directly affects valuation. If both companies expect $100 in annual cash flow forever, Company A will have a valuation of about $1,111, while company B's valuation would fall to about $833. So, the higher beta company requires a higher return. This results in a higher discount rate driving a lower valuation. That's the chain of cause and effect. Rule 6, taxes shape value. The weighted average cost of capital, or WACC, is the hurdle rate a company uses to decide whether an investment creates value. If a project's return is greater than the WACC, it should add value to the firm. We calculate WACC by weighting the cost of equity and the after-tax cost of debt by their share of the company's capital structure. Cost of equity is what shareholders require to invest, often estimated using CAPM. Cost of debt is the interest rate lenders charge, but we adjust it downward because interest is tax deductible. This is called the tax shield. Why does this matter? If corporate tax rates fall, the value of the debt tax shield shrinks. That makes the after-tax cost of debt higher, which raises the overall WACC. It feels counterintuitive, but it simply means companies can't rely as much on the tax benefits of borrowing. Rule 7. A dollar tomorrow isn't a dollar today. In finance, value is the present value of all expected future cash flows. The income approach focuses on forecasting these flows and discounting them back to today. The method you use depends on the pattern of the cash flows. Annuities are fixed payments for a specific period. Think of a bond's coupon payments. You can value them with the annuity formula. Perpetuities are fixed payments that last forever. Their value is simply the fixed payment divided by the discount rate. A share of preferred stock is a classic example. Growing perpetuities are payments that grow at a constant rate forever. The Gordon growth model applies here, where value equals the next year's dividend divided by the discount rate minus the growth rate. This is key for valuing stable, mature companies. Uneven cash flows are for assets with irregular profits, where you use a full discounted cash flow DCF analysis, projecting and discounting each year's cash flow individually. The income approach is all about modeling the future and translating it into today's dollars. But always remember, these models are highly sensitive to your discount rate and growth assumptions. Rule 8, value is relative. While the income approach looks inward at a company's own cash flow, the market approach looks outward, and the cost approaches look backward. The market approach asks, what are similar assets or companies selling for? This relies on relative valuation multiples. The most famous multiple is the price-to-earnings ratio, which is ideal for profitable, stable companies. However, PE doesn't account for growth, which can be misleading. To solve this, analysts use the PEG ratio, PE to growth, which levels the playing field when comparing companies with different growth rates. For high growth or unprofitable startups, PE is useless. Instead, the go-to multiple is enterprise value to sales, EV to sales. Sales are a much more stable metric than volatile or negative earnings. This ratio helps value the entire business operation, independent of its debt or cash levels. The price-to-book multiple is best for asset-heavy industries like banks and insurance companies, or for distressed situations where the liquidation value of tangible assets is the primary source of worth. The cost approach asks a simple question: what would it cost to rebuild or replace this asset from scratch today? This replacement cost is most useful for unique assets like infrastructure or specialized machinery where market comps are rare and future cash flows are difficult to predict. The key is to match the method to the asset. You wouldn't use a PE ratio on an unprofitable startup, and you wouldn't use a DCF to value a piece of fine art. Understanding all three approaches gives you a comprehensive toolkit to value anything. Rule 9, dollars beat percentages. Two of the most common capital budgeting tools are net present value, NPV, and internal rate of return, IRR. IRR is the discount rate that makes a project's NPV equal 0. In simpler terms, it shows the project's percentage rate of return. NPV is the total dollar value a project adds to the firm, the present value of cash inflows minus outflows. Here's the rule: when projects are mutually exclusive, always choose the one with the higher NPV. That's because NPV measures absolute value creation, not just efficiency. Imagine two projects. Project A requires $1,000 and generates $2,000 in returns. Your IRR equals 100% and your NPV equals $1,000. Project B requires $1 million and generates $1,200,000 in returns. Your IRR equals 20%, but your NPV equals $200,000. Even though Project A has the higher IRR, Project B adds far more value to the company in dollar terms. IRR is useful for understanding efficiency, but NPV is the true measure of shareholder wealth creation. Always follow the money and the project with the higher NPV. Rule 10, what you see isn't what you pay. When you see a bond quote, it's almost always showing the clean price, the quoted market value without any accrued interest. But what you actually pay is the dirty price, which equals the clean price plus any interest the bond has earned since the last coupon payment. That's because if you buy the bond mid-cycle, the seller is entitled to the interest they've already accrued. On the exact coupon date, accrued interest resets to zero, so the clean price and dirty price are the same. Suppose a bond's clean price is $1,000 and it pays $50 of interest every 6 months. If you buy it halfway between coupon dates, you owe the seller about $25 in accrued interest. Your invoice, or dirty price, is $1,025. Always check whether you're looking at the clean or dirty price before comparing bond values. The distinction matters for both exams and real-world investing. Master these 10 rules and you'll not only ace the exam, but also start thinking like a real analyst. Thank you for your time and have a great day.